Let me tell you about the most expensive investing decision you'll ever make. And here is the twist. It's got nothing to do with which stocks you pick. You see, we spend all of our energy on wrong questions. Which fund, which company is now a good time to buy? And look, those questions, those stuffs matter a little. But there's a decision sitting underneath all of that. Quieter, more boring, and what's potentially hundreds of thousands of dollars over your lifetime. It's not what you buy, it's where you put it. The account you live in, the wrapper around your money. Wealthy investors figured this out a long time ago. They obsess less over the asset themselves and more over the sequence, the order in which their money fills up different kinds of accounts. And once you see it, you cannot unsee it. Let me show you with the simplest example I can. Picture two people, same exact index fund, same 30 years, same market, same returns. Identical in every way, except one holds it a tax account and the other holds it in a regular taxable brokerage account. 30 years later, the person in the taxable account ends up with thousands of dollars less. Same investment, same performance, different wrapper. That's the whole difference. Here's the picture I want you to hold in your head for the next 15 minutes. Investing in a full taxable account is like driving a sports car with emergency brakes engaged. Engine is fine, the car is fine, but something is quietly dragging against you the entire way, and you're burning fuel just to fight. So today I'm going to walk you through the exact sequence, the waterfall that wealthy investors use to make sure every dollar is shielded from taxes it never had to pay. Quick and honest disclaimer before we start. This is a general education, not personalized advice, because everyone's situation is different. The order of operation I'm about to give you is about as close to a universal blueprint as personal finance has. Alright, let's get into it then. First, you have to name the enemy. And the enemy is a thing called tax drag. You see, every year in a taxable account, you get taxed on things you might not even realize are happening. Dividends the funds pay out, capital gains distribution the funds passes along to you, even if you never sold a single share. The tax bill shows up, and every one of those little bites takes money out of your account. Money that was supposed to stay in there and compound and grow on itself year after year. That's the drag. It's friction, and it's friction over decades, and it's brutal. Let me put real numbers under it because this is the part that should make you sit up. Say you've got a 100,000 portfolio and it returns 7% a year for 30 years. Left completely alone, that grows to over 700. Beautiful. That's compounding doing its job right. Now, had just 1% annual tax drag. Doesn't sound like much, right? 1%. But watch the same portfolio now grows to only $574. You just lost nearly $200,000, not to a market crash, not to a bad stock peak, purely to structural friction, to the wrapper, to taxes you might have legally avoided. So let that reframe the whole game for you. Finding a great investment is pointless if your account structure is quietly leaking capital out the bottom the entire time. You can win the stock picking game and still lose the wealth game, which is exactly why the sequence matters so much. So let's build it, one tier at a time. This is the waterfall. The very first place your money goes isn't an investment at all. It's a cash cushion. 3 to 6 months of living expenses. Sitting in one boring, safe, high yield savings account. I call it the wrong way. Now, I know for an investing video, telling you to hold cash sounds backward. Cash is the thing we just spent 5 minutes saying inflation hits a lot. That's correct. So why is this the first step? Well, here's the mechanics, and it's more clever than it looks. That cash isn't there to grow at all. It's there to protect the growth of everything else. Think about what happens without it. You lose your job or you get ill with a surprise medical bill. And let's say it happens during a market downturn, because that's exactly when layoffs tend to cluster. If you have no cash buffer, what are you forced to do? You have to sell your investment at the worst possible moment, at a loss. You're ripping money out of your compounding engine right when prices are on the floor. The emergency fund exists specifically to prevent that from happening. It's the insurance policy that lets the rest of your portfolio keep compounding on the stop through the rough patches. It buys your investment the one thing they need the most, time, without first interruptions. So before a single dollar goes into the market, you build a runway. Then, and only then, it will open but tap. The runway is built, now the water starts flowing. The very first investment here is your workplace 401k, but only up to the one specific point, whatever your employer will match. This is the single best deal in all of finance, and I don't say that lightly. You see, capturing your employer's match is the only place you get a guaranteed instant and return on your money. Not 7%, not 10%, even before the market opens. Let me show you the mechanics with a real number. Say you earn $100,000 and your employer offers a very common match. They will match 100% of the first 3 you put in. They have 50% of the next 2%. So you contribute 5% of your salary. That's fine. Watch what the employer adds on top. On the first 3%, which is the first $3,000 that you put in, they match every dollar. That's another $3,000 for you. On the next 2%, which is the next $2,000 you put in, they match that half. Another $1,000 half to it. So you put in 5 and instantly it becomes $9,000. You just made $4,000 out of thin air before you even pick a single investment. Now, here's how big the container is. For 2026, the IRS lets you personally put up to $24,000 into your 401k. And when you count your contribution plus everything your employer has, the combined ceiling is usual. But at this step, we're not trying to fill the whole thing. We're just grabbing the free money, the match, and then we move on because there are better tax accounts to fill first. Let me be blunt about why this is step 2 and not step 10. You see, refusing to capture your employer match is mathematically equal to your boss offering you a raise and you say no. Nobody would do that on purpose. People do it every single day just by not contributing. So grab the match every time. It's the undisputed first priority for any invested dollar. Alright, guess where it's getting interesting, because the next account is the most powerful one almost nobody talks about. The health savings account, the HSA. Now, there's one gate you have to pass through to use this. You need to be enrolled in a high deductible health plan. Not everyone is, and that's fine. If you qualify, the tax benefits are simply unmatched by any other savings account in existence. And here is why. You see, every other account gives you a tax break in one direction. The HSA gives you in 3. This is the famous triple tax advantage. So let me walk each one. 1, the money you put in is actually tax deductible. It lowers your tax income the year you contribute. Number 2, the money grows completely tax-free while it's invested. No drag, no friction, none of that leak we talked about. And 3, when you pull it out to pay for medical expenses, those withdrawals are also tax-free. Tax-free going in, tax-free growing, tax-free coming out. No other account does all 3. It's the only one. For 2026, an individual can put in $4,000 and family can set aside it. But here's the move that turns the HSA from an healthcare account into a stealth retirement account. And this is the part the wealthy love. You're allowed to pay your current medical bills out of your own pocket instead of the HSA. So you do that, you cover today's cost for regular cash, and you keep the receipt. Meanwhile, the money inside the HSA stays invested and compounds untouched for years, even decades. And then, this is the beautiful part. Far down the road, you can reimburse yourself for all those medical expenses, tax-free, using receipts from 20 years ago. You've let the money grow the entire time, and you can still pull it out clean. That's how a health account quietly becomes one of the best retirement accounts you own. The next step in the waterfall, the Roth is. And the Roth runs on a completely different philosophy from your firm. So let me make the contrast crystal clear, because it's the key to the whole thing. You see, with a traditional firm, you get the tax break now. The money goes in before taxes. You pay the taxes later when you withdraw in retirement. The Roth flips that. With a Roth, you pay your taxes up front today with money that's already been taxed. But in exchange, everything after that is permanently, gloriously tax-free. The growth is tax-free. The withdrawal in retirement is tax-free. And there is no required minimum contribution, meaning the government never forces you to start pulling the money out at a certain age. You are in control for life. All right? Now, for 2026, you can put in $7,500 into a Roth. One thing to watch though, the ability to contribute directly starts phasing out at a higher income, about roughly $150 if you file single, or $240 if you're married filing jointly. Above those lines, the direct path narrows and people look at other routes. But for a huge number of earners, the door is pretty wide open. So why do the wealthy love Roth so much? It comes down to what I call the haircut you avoid. Let me show you. Imagine an investment grows and you've got a $50,000 profit. In a normal taxable brokerage account, the moment you sell, the IRS takes its course at the long-term capital gain rate. That's often like 15%. So 7 of your gain gone. But in Roth, you keep every single cent of that $50,000, no haircut, nothing. Now, multiply that across the entire portfolio, across decades. What you're building inside a Roth is a massive reservoir of completely tax-free money you can tap in retirement. And that reservoir does something sneaky and wonderful because Roth withdrawal don't count as taxable income. They can actually keep your old tax bracket lower in retirement. In other words, you're not just saving on this account, you're lowering the temperature on your entire tax picture later in life. Let's take a deep breath and see where we are. You built your wrong way, you grab the free match, you fill the HSA, you max the Roth. Look at how much of your money is now sitting inside tax shelters. That's the whole point here. So now, and only now, we circle back to the 401k one more time. Remember, we only took the match earlier, but the container owes up to 24 of your own money for 2020. And most people haven't filled it yet. So this is the step where you go back and point as much of that remaining room as you can. Why did we set this for now instead of doing it back at step 2? You see, because the HSA and the Roth have better tax bucket. The HSA with its triple advantage, the Roth with its tax-free forever. Smart sequencing means you fill the best shelter first and come back to finish the merely very good ones after. Order of operation, that's the entire game here. Only after all those shields are completely full do we move to the last tier. And here it is, the bottom of the waterfall, the standard taxable brokerage account. This is the overflow trap. It's where the water goes after every tax advantage bucket above it is full. Now, don't get me wrong, the brokerage account is genuinely useful. Its superpower is total flexibility because there are no contribution limit, no early withdrawal penalties, there's no rule about when you can touch it. Need the money next Tuesday is right there. That freedom is real and is very valuable. However, it offers exactly zero protection from IRS. This is where the tax drag lives and where it's most aggressive. Remember our sports car with the emergency brake? This is the account where that brake is fully engaged. Inside a brokerage account, your dividend and your short-term gains can get taxed as ordinary income. And for high earners, that rates climb as high as 37, more than a thought, skimmed off the top. That's the leak we've spent the whole video trying to plot. So the brokerage account isn't bad, it's just undefended. You only want your money standing out there in the open, exposed to the drag after you've packed every sheltered account you possibly can. Overflow. So let's trace the whole thing back one more time, because when you see it in sequence, it just clicks. The water starts at the top with your emergency fund. The wrong way, that protects everything below. Then it spills into your phone just far enough to grab the full employer match. Your guaranteed free money. From there, it flows into HSA and that unbeatable triple tax advantage. Then, of course, into the Roth IRA for permanent tax-free growth. Then it looks back into your 401k. And finally, whatever's still left over spills down into the taxable brokerage account. The flexible, unprotected overflow at the very bottom. Same dollar, same investment, but run through the right sequence to get shooted at every level on the way down. Run through the wrong sequence or no sequence at all, and you quietly bleed value the whole way, year after year, exactly like that $200,000 we watched evaporated at the very start. That's the real secret. It was never really about picking the perfect stock. It's about the order of operation, the wrapper around every dollar. Great investors don't just think about what they earn, they think obsessively about how much of it they get to keep. Take the emergency brake off. Let the thing actually run. I'll see you in the next one.